Welcome, curious minds, to another deep dive. Today we're setting our compass for the stunning but economically really dynamic waters of the Caribbean. We're not just looking for sandy beaches, though. Oh, no. We're diving headfirst into the fascinating world of exchange rate regimes in these vibrant nations. Our mission: to really unpack how these countries manage their currencies, the strategic choices they make, and critically, what it all means for their economies and, well, ultimately for you, our listener. We gathered some fantastic insights from recent data, giving us a pretty clear picture, actually, looking at how different Caribbean nations are structuring their currency frameworks right now, sort of 2023 through 2025. It promises to be a really eye-opening journey, thinking about stability, flexibility, and those tough choices leaders face.
And that's exactly right. You see, a country's choice of exchange rate regime, it isn't just some obscure detail you'd find buried in a central bank report. It's really a foundational economic decision. It has profound implications for almost everything. We're talking national stability, trade competitiveness, even the everyday cost of living. Nations are constantly navigating this incredibly delicate balance. It's like, how much certainty do you want from a fixed rate versus, well, the flexibility a floating rate offers to respond to global shifts? It's a core strategic decision, and it profoundly shapes an economy's resilience and its path forward.
Absolutely. So let's navigate these waters, maybe starting with what many consider the most straightforward approach,
Yeah.
the fixed peg or conventional peg.
Yeah.
For our listeners, what does it truly mean when a country decides to, well, fix its currency?
Okay. Essentially, a fixed peg means the local currency's value is locked. It's held constant against another currency. Usually, it's a highly stable international currency like the US dollar. You can almost think of it like anchoring your economic ship to a very sturdy, predictable dock. One of the most compelling examples from our sources, and really globally, is the Eastern Caribbean Currency Union, the ECCU. Their currency, the Eastern Caribbean dollar, the XCD, it's been fixed at 2.70 XCD to 1 US dollar since way back in 1976.
Wow, 1976.
Yeah, since 1976.
That's nearly 50 years of just unwavering consistency.
It is. It's a remarkable commitment to a specific monetary policy.
50 years is an incredible run for any economic policy, isn't it?
Yeah.
It really suggests a powerful belief in the benefits of that stability. Now, while the ECCU is, as you say, a unique case because it's a union, our sources highlight that this fixed peg strategy isn't exactly an isolated choice in the Caribbean. What other nations in the region are making this kind of commitment? And what might be the common drivers behind it?
You're right. It's actually a pretty popular choice for many. We see countries like Aruba, the Bahamas, Barbados, the Cayman Islands,
Yeah.
and also Curacao and St. Martin. They also maintain these conventional fixed pegs, usually against the US dollar, yeah. The common thread here for many of these small, open Caribbean economies, they're heavily reliant on tourism, trade, often significant imports. The paramount concern is predictability and trust. The advantages are pretty clear. You get enhanced stability, which tends to keep inflation lower. This makes it far easier for businesses to plan, for people to budget, and for foreign investors and tourists to engage, right? Because they know the value of their money. However, this stability certainly comes at a cost, a significant one. The main disadvantages are, first, the need for substantial foreign currency reserves. You have to be able to defend that peg. And crucially, there's a significant loss of monetary policy autonomy. Your central bank can't easily just adjust interest rates or the money supply to stimulate the local economy if those actions might threaten the peg. What's truly insightful here, I think, is that for these nations, choosing a fixed peg is often a very deliberate strategic decision. It's almost like outsourcing their monetary policy in a way. They aim to mitigate local inflationary pressures and actively attract foreign investment and tourism by offering this really stable financial environment. It's a choice that trades that flexibility for, well, profound trust and predictability.
That's a great way to put it, outsourcing monetary policy. And speaking of the ECCU again, which you highlighted, it's not just one country with a fixed peg, is it? It's a currency union of 8 distinct nations. Anguilla and Antigua and Barbuda, Dominica, Grenada, Montserrat, St. Kitts and Nevis, St. Lucia, St. Vincent and the Grenadines, they all share the Eastern Caribbean dollar and a single central bank. How does forming a union like that amplify both the benefits and, I guess, the constraints you just mentioned?
That's an excellent point. Yeah, a currency union like the ECCU essentially takes the individual benefits of a fixed peg, that stability, the ease of trade, the confidence, and it projects them across multiple nations. It creates a larger, more integrated economic bloc. This can certainly amplify the advantages. It can foster regional trade and shared economic resilience. But you're absolutely right. It also means they share the constraints. That collective loss of individual monetary policy autonomy is real, And there's the collective responsibility to maintain those foreign reserves to defend the shared peg. It requires immense coordination and shared economic goals. But it's a powerful model for deepening regional integration, no doubt.
Okay, so we've explored the steadfast anchored world of fixed pegs and currency unions. Very stable. But what happens when a country chooses not to anchor its currency? When it allows it to maybe float more freely with the economic tides?
Right. So when a currency is floating, its exchange rate is primarily determined by market forces. Basically, supply and demand for that currency on the global market. Think of it more like a boat freely moving on the open sea. It responds to the currents and winds. Now, while it's generally free-moving, central banks in these regimes often keep a close eye on things. They may still step in if the volatility gets too extreme, acting like a guiding hand to prevent wild, destabilizing swings.
Okay, like a managed float almost, or is that something different? We'll get to that. But first, which Caribbean nations primarily embrace this more market-driven approach according to our sources?
Yeah, our sources indicate that Trinidad and Tobago, with its TTD, the Dominican Republic with the DOP, Haiti with the Haitian Gourde, and Suriname with the SRD. These primarily operate under floating regimes. These nations are, for the most part, letting market forces determine their currency's value against others, the advantages of floating regimes. They mostly center around greater monetary autonomy. Unlike countries with fixed pegs, their central banks have the freedom, right? They can adjust interest rates or manage the money supply to address domestic economic challenges without having to constantly worry about defending a fixed rate. This also gives them a greater ability to absorb external economic shocks. Things like sudden shifts in commodity prices or global demand, the currency's value can naturally adjust. It acts as an automatic stabilizer. However, the downside is, predictably, more volatile exchange rates.
Right, less certainty.
Exactly. This can create uncertainty for businesses and consumers. And there's also the risk of what's often called imported inflation. This happens when your currency weakens significantly, making everything you buy from abroad, like food, fuel, electronics, much more expensive in local terms, which can then push up domestic prices across the whole economy. For smaller economies, this kind of volatility can be particularly challenging to manage.
So we've seen the two extremes, the firmly anchored fixed peg and the free-floating currency, more exposed to market currents. But what about the middle ground? You hinted at it. Our sources talk about stabilized arrangements or managed floats. How is this approach different from a pure free float? What's the strategic thinking here? It sounds like an attempt to maybe get the best of both worlds.
It is precisely that. It's an attempt to find that sweet spot between stability and flexibility. A stabilized arrangement is technically a floating regime, so it's not officially pegged. However, the central bank actively intervenes in the foreign exchange market. They step in to smooth out fluctuations and maintain a relative degree of stability. Specifically, they try to prevent abrupt and disruptive swings. It's like having that boat on the open sea, but with a skilled captain at the helm, constantly making small adjustments to keep the journey steady, even with waves. Guyana, with its Guyanese dollar, the GYD, is a key example here. Its rate is nominally floating, but it's protected from big, sudden movements through periodic interventions by their central bank. And similarly, Jamaica, while operating a free-floating regime for its JMD, you see the Bank of Jamaica make occasional interventions to manage extreme volatility. If we connect this to the bigger picture, it really shows that exchange rate management isn't just two distinct, rigid boxes, right? It's actually a sophisticated spectrum of control. Countries can strategically tailor their approach. They adapt to their specific economic needs and vulnerabilities, finding a balance that works for them.
That distinction really helps clarify things. Yeah, it's not just black and white. So what does all this talk about pegs, floats, and managed arrangements, what does it ultimately mean for you, our listener? These sound like highly technical discussions, but clearly they must have real-world impacts, whether you live in the Caribbean, maybe plan to visit, or do business there.
Oh, absolutely they do, and in very tangible ways. A country's exchange rate regime can directly impact your daily life. Think about the cost of imported goods, for example. If you're in a country with a fixed peg, those prices tend to be more stable month to month. But if your currency is floating and suddenly weakens, well, your imported groceries, the fuel for your car, maybe that new smartphone, they could suddenly become much more expensive. It also affects the value of your savings, doesn't it? And the general stability of prices in the economy. Even the predictability of travel costs if you're a tourist. For businesses, knowing whether a currency is fixed, floating, or managed is absolutely crucial. For planning trade deals, making investment decisions, hedging against currency risk, it directly influences economic predictability and confidence. It shapes everything from employment to investment levels.
That really brings it home. It connects the policy to the pocketbook, so to speak. And what's definitely clear from our deep dive today is that there isn't a single one-size-fits-all solution. Not at all. Each regime, fixed, floating, or managed, has its own unique set of pros and cons. A country's choice often reflects its specific economic structure, its national priorities, and the particular types of external shocks it's most vulnerable to. A tourism-heavy economy, for instance, might prioritize that stability that attracts visitors and foreign investment. Makes sense. While maybe a nation rich in natural resources might need the flexibility of a float to absorb sudden swings in global commodity prices. It's a complex and really strategic balancing act for sure. So as we wrap up this deep dive, we've navigated the fascinating range of exchange rate frameworks across the Caribbean, from the unwavering stability of fixed pegs and currency unions anchoring multiple economies together, to the market-driven dynamics of floating currencies and that nuanced guiding hand of stabilized arrangements that try to blend both approaches.
And what's clear is that these are not simple off-the-shelf decisions, not by a long shot. They reflect deep economic considerations, thinking about resilience, about growth, and ultimately about the overall well-being and stability of a nation. Each approach is a carefully weighed strategy. It's about navigating the complexities and, frankly, the challenges of the global economy.
So, as you go about your day, here's a thought to perhaps consider. How might major global economic shifts, like, say, a prolonged period of high inflation in the U.S., or maybe a significant change in global demand for key Caribbean exports, how might those shifts impact countries with these different exchange rate regimes? Which systems might prove more resilient in a turbulent economic sea and which might face greater challenges? Something to mull over as you think about the interconnected world we all live in. Thank you for joining us on this deep dive.